Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we continue our coverage of what is a huge week for developments in Asia, with the US President, Donald Trump, now in Japan. President Trump's meeting with Japan's new Prime Minister Takaichi in Tokyo offered warm words about friendship and defense. The real stakes lie in the shifting economic architecture of the US-Japan alliance. Behind the gestures of golf hats and pledges of loyalty, both leaders are recalibrating how money, markets, and minerals flow across the Pacific. Quote, "Anytime you have any questions, any doubt, anything you want, any favors you need, anything I can do to help Japan, we will be there," end quote, the US President said, adding, quote, "We are an ally at the strongest level," end quote. That warmth masks harder calculations. Both nations are grappling with China's expanding economic footprint, the fragility of supply chains exposed by recent global shocks, and rising debt burdens at home, something we will touch on later in today's episode. The Tokyo meeting, Trump's second major stop in a three-nation Asian tour this week, the previous one being Malaysia, which we covered in yesterday's video, was designed to show that the two largest advanced economies in Asia and North America can still drive growth together even amid nationalist headwinds. At the center of the summit was a $550 billion Japanese commitment to fund projects in the United States. An enormous headline figure, but one surrounded by ambiguity. Trump portrayed it as capital that his administration could, quote, "invest as we like," end quote, claiming 90% of the profits for the US. Tokyo, however, insists that it is a mixture of investments, loans, and guarantees aimed at supporting Japanese firms expanding in America. The White House fact sheet offered little clarity. Its trade statement merely, quote, "noted with satisfaction," end quote, ongoing efforts, and the accompanying critical minerals pact amounted to a pledge to cooperate on permitting, financing, and mapping, short on measurable targets. Still, the optics serve both sides. For the US president, it reinforces his narrative that foreign partners are financing US growth and American jobs. For Takaichi, it signals Japan's seriousness about securing preferential access to US industrial and clean energy supply chains without committing hard budget cash up front. The underlying trade deal caps most Japanese exports to the United States at a maximum 15% tariff, with safeguards ensuring Tokyo won't be disadvantaged in future sectoral negotiations over semiconductors or pharmaceuticals. In a global climate of protectionism, those guardrails are vital. Japan's exporters, especially in autos, machinery, and precision components, have been wary of Trump's transactional trade style. The latest framework, though imprecise, gives them a measure of predictability. It also aligns with Takaichi's broader agenda to anchor Japan's manufacturing in friendlier markets while diversifying away from China, which still absorbs more than a fifth of Japan's exports. Takaichi's domestic agenda is equally consequential. Facing sluggish growth and heavy public debt, she is pushing what she calls responsible, proactive fiscal policy. Her goal: boost demand without raising taxes, lift wages for essential workers, and reduce the social security burden on working families. She promises to keep debt growth below GDP growth, a subtle signal to bond markets that Japan will remain fiscally disciplined even as spending rises. Her program also extends the Abenomics tradition of fusing monetary stimulus with industrial investment. The new Prime Minister has earmarked strategic sectors such as artificial intelligence, quantum computing, shipbuilding, biotechnology, and nuclear energy, echoing Trump's own rhetoric of rebuilding domestic industry. If successful, Japan's stimulus could generate new opportunities for US investors and technology partners, particularly as Tokyo backs homegrown semiconductor capacity and next-generation energy projects like the next generation of solar cells and nuclear fusion. The Tokyo agreements also form part of Washington's broader bid to contain China's economic leverage through coordinated investment networks. Trump's Asia inventory, linking Japan, Malaysia, and South Korea, emphasizes critical minerals cooperation, friendly shoring of manufacturing, and financing of infrastructure that can rival Beijing's Belt and Road programs. Meanwhile, China's Premier Li Qiang, speaking in Kuala Lumpur earlier this week, decried, quote, unresponsible irresponsible tariffs and unilateralism, end quote, a clear rebuttal to the US strategy. In that light, Japan's participation is both economic and geopolitical. It signals that Tokyo is preparing to tie its recovery to a US-led industrial bloc rather than risk dependence on Chinese supply chains. A mistake, arguably, the Europeans have discovered that they have made. While Trump and Takaichi exchanged personal praise, she promised to nominate him for the Nobel Peace Prize, reportedly, their alliance is being reshaped less by sentiment than by mutual economic necessity. Trump needs tangible foreign investment to underpin his growth promises. Takaichi needs American markets and security cover, as she front-loads defense spending and reforms Japan's economy. Both leaders gain from keeping the details murky. The vagueness gives them flexibility to claim victories at home while adapting to fiscal and geopolitical realities abroad. For all the talk of friendship, the Tokyo meeting revealed something more enduring, an evolving economic compact between two aging but innovative democracies, seeking stability and profit in an increasingly volatile world. Next up, UK food bills fell at their fastest pace in almost 5 years in October, offering a glimmer of relief for households squeezed by inflation. According to the British Retail Consortium, BRC, food prices dropped 0.4% month-on-month, the biggest decline since late 2020, driven largely by falling global sugar prices. Chocolate and confectionery costs eased, providing, quote, a treat for those preparing Halloween parties, end quote, said BRC Chief Executive Helen Dickinson. Global sugar futures have plunged over 25% since January due to abundant supply. Across the broader retail landscape, overall shop prices fell 0.3% from September, with discounts on electronics and health and beauty products contributing to the decline. Annual shop price inflation eased to 1% in October, ending a 7-month streak of rising pressures. Food inflation also slowed to 3.7% year-on-year, down from 4.2% in September. The figures bolster optimism that inflation may be moderating, prompting traders to revive bets on the Bank of England rate cut before year-end. Still, supermarket lenders warn that rising taxes could drive prices higher again next year. Quote, our ability to absorb additional costs is diminishing, end quote, executives from Tesco and others cautioned in a joint letter to Chancellor Rachel Reeves. Next up, we move to North America and we discuss the deteriorating US public debt situation. But just quickly, if you want to continue to be on top of developments like today's, the most up-to-date analysis on the biggest developments in the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, the United States is on course to overtake Italy and Greece in government debt levels for the first time this century, the International Monetary Fund has warned, spotlighting the deteriorating state of America's public finances. According to the IMF's latest forecasts published in recent days, US gross government debt will climb by more than 20 percentage points to 143.4% of GDP by 2030, surpassing previous peaks reached during the pandemic. Over the same period, Washington's budget deficit is projected to remain above 7% of GDP every year, the highest among advanced economies. While Italy and Greece, once the poster children of Europe's sovereign debt crisis, are expected to gradually reduce their debt burdens through tighter fiscal controls. The US trajectory is set in the opposite direction. Both European countries are now recording improving primary balances, with Italy's deficit expected to narrow to 3% of GDP this year, paving the way to exit the EU's excessive deficit procedure ahead of schedule. Quote, it's a symbolic moment, end quote, said the head of global macro at Amundi Investment Institute, adding, quote, according to the CBO, the projections are for US debt to carry on rising. That is the impact of running perpetual deficits, end quote. Despite its worsening fiscal picture, the US enjoys unique borrowing capacity thanks to the dollar's role as the global reserve currency. Yet some analysts warn that the perception of US fiscal superiority over Europe may soon erode. Quote, many US politicians and investors look down on Europe's slow growth economics, end quote, said ING economist James Knightley. Quote, but when you have metrics like this, the conversation changes, end quote. The IMF's projection projections indicate limited fiscal restraint under both Biden and Trump administrations. One senior Treasury advisor defended the government's record, citing tariff-driven revenue gains and recent improvements in the deficit since April, something we covered earlier this month. Alternative IMF data show that on a net debt basis, subtracting government financial assets, the US remains about 10 percentage points below Italy's debt levels by decade's end. Still, both measures are trending upward, a sign of persistent structural imbalances. Quote, "The US political dynamic makes deficit reduction hard," end quote, said Joe Gagnon of the Peterson Institute, adding, quote, "Democrats won't cut spending, Republicans won't raise taxes. I don't know when that changes," end quote. Former IMF chief economist Murray Obstfeld was blunter. Quote, "Any forecast claiming the US fiscal position is sustainable rests on wishful thinking about productivity, tariffs, demographics, or interest rates, or perhaps all of them," end quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I hope to see you for the next episode tomorrow.